Hello traders, here. This is Chris Capri, secondsguysforex.com. In terms of how I make my trading decisions, I have two main kind of models or methodologies that I approach the markets. And one of them is price action context, and the other one is Ichimoku trading. We're going to be talking about my approach using price action context today. And the way I approach this is kind of based on a very fundamental principle, which is that it doesn't matter whether you are a sentiment trader, flow trader, or a technical trader or a fundamental trader. Eventually, all of your trading decisions will come down to whatever information you're taking in to make your trading decisions. They will all have to culminate in the result of you making a trade. You'll have to, whatever your reason is, you're eventually going to hit the buy or sell button based upon that information. Once you make that trading decision and your order gets activated, it becomes actualized order flow. And the most proximate driver of all price action you see in the markets, from all these charts, things moving up, moving down, ranges, whatever, the most proximate driver of price action is order flow. So in my opinion, it doesn't really matter when people ask, oh, well, is technicals better than fundamentals and fundamentals better than technicals? None of that really matters, because the bottom line is you're going to have to make a trading decision. And I want to make my trading decisions based upon the most dominant order flow in the market, because whatever the most dominant order flow in the market is, whether it's bullish or bearish, they're going to win. That's what's going to drive price. And so my job as a trader is to find what is the most dominant order flow in the market and what's driving price so that I can trade with that move. And I use price action context to do that. So I don't trade candlestick patterns. Trading candlesticks does not make you a price action trader. It makes you a candlestick trader. I trade price action context, and I use specific models to help you and myself and anyone who uses these models to see the dominant order flow in the market. Who's in control, who's not, where's the momentum, where is it not, where are they taking profit, where are they not, where are they pushing the market, breaking out, finding resistance, to use all these different models to help you see who's in control, who's not, and trade with that. And I'm going to start off by talking about one of those particular models, what I call impulsive and corrective price action. So let me go to a 4-hour chart here. Okay, so we're now looking at the ASX 200. This is their Australian index. It's kind of like their S&P 500, so to say. What I want to talk about is one of the first kind of pillars or models for reading price action context in real time. And when you learn this particular model and really build it as a skill, you find yourself being able to really see kind of more of what's going on with the order flow behind the market. And this is super important because it'll be very informative for making crucial trading decisions. So one of the first models is impulsive and corrective price action. And if you think about the word impulsive, what it kind of has this fast, vigorous, high energy movement to it. And that's kind of what an impulsive move is like. And to kind of describe it, I'm going to codify it for you, but the most important thing you need to understand about this is an impulsive move is a very dominant move from one side of the market, the bulls or the bears. And dominant moves are important because, one, you don't want to trade against them. You want to be trading with them as much as possible. And so when you trade with them, you're trading with the dominant order flow in the market. And a way to do this is to identify impulsive moves. So there are 3 variables that will help you identify whether a move is impulsive or corrective. And the first variable to identify an impulsive move is that the majority of candles in that move are of one color, so they're predominantly one color. And in this case, when we look at this particular move here, with all these candles in between, this is pretty much all blue candles. And so why is this such an important characteristic for defining an impulsive move? Well, here we have a 4-hour chart. Every one of these candles represents 4 hours of price action. And so if you have, in this case, 1, 2, 3, 4, 5, 6, 7, 8, 9. So out of 9 candles, 8 of them out of 9 were bullish. So it's 32 hours of 32 out of 36 hours the index is being bought up. That's several days of trading. And so that should be communicating to you that the market is just continually buying hour after hour after hour. They're not even running into bears, and if they are, they're just steamrolling them. By the order flow being consistently dominant over time, that really gives you a good window into who's in control from a time perspective and from kind of this force perspective. Every single hour after hour, they're just continually buying it up more and more and more. And so that's a very powerful piece of information to tell you when there is a dominant player in the market, dominant directional move, and thus an impulsive move. So that's the first characteristic. The second characteristic of an impulsive move is that the majority of closes are near the highs. And so if you look at this, the market opened, it didn't go 1 point down, climbed from the open, went up, and then closed just a few points off the high. Again here, goes up, and it closes a few points off the high. Closes a few points off the high. Barely closed off the high. This one's kind of an indecisive one, but then this one just barely closed off the high. This one closed toward the middle, and then this one closed towards the highs. Why is closing towards the highs a good defining characteristic of an impulsive move? This is important because if you think about it, for this entire 4-hour candle, by closing near the highs, the bulls are not taking their foot off the gas. They're just buying up for the entire 4 hours, and 4 hours is about half a trading session. So for half a trading session, they're just buying it up, buying it up, buying it up, and they're just continually putting on the pressure, and there's very little profit taking. When you have little profit taking, that usually produces just small pullbacks from the highs and bull moves and from the lows and bear moves. And so closes towards the highs and bull moves or closes towards the lows and bear moves indicate that the downward pressure is remaining even into the close of the candle. And when you have many of these, then it's kind of signifying or communicating that the bulls really aren't taking any pressure off right now. They're just continuing to press forward. So that's the second characteristic of an impulsive move. And the third characteristic of an impulsive move is large candles. Larger candles indicate more buying force, more buying pressure, greater imbalance. If it's a bullish candle, then there's more imbalance to the bull side. And if it's a bearish candle, there's more imbalance to the bear side. The larger the candle, the greater the imbalance. The greater the force, the greater the order flow, the greater the movement towards the price action and the order flow moving the price action in that particular direction. And so if you look at all these candles, they're all pretty large except for this one. Whereas look at all the price action in this one here. This first candle. Here's the high, 62.67. Here's the low. And look how much of the prior move is contained inside this one candle. It's like 8-10 candles. So 8-10 selling candles could barely equal one candle of buying pressure. So this is large candles indicate large force, large momentum, a lot of order flow behind it. Thus, it's a very good defining characteristic of an impulsive move. Now, a corrective move is just the opposite of an impulsive move. And I can show you one very easily in this chart. Actually, a lot of them. So I'll draw in here, and here, and here. Corrective moves are the opposite. Instead of big candles, they're small candles. Instead of the candles being mostly one color, they're a mix. Instead of the closes being near the lows, they're right in the middle. And so, what we see with these types of moves is that they're not being dominated by one side of the market. They're not. There's not an imbalance on either side. And so that can give us a lot of information. If we see a corrective move, we shouldn't be under the assumption that the market's just going to move very forcefully to our target. If we're trading, let's say we have a trade and we're, let's just say we have a trade open, we're long, and it's moving correctively like this. Well, then we understand that, hey, just because the market isn't moving towards our target, it's not a problem because we're in a corrective structure. The market's not really finding an imbalance right now. Only until the next imbalance comes, we really know whether, the market is kind of turning against us or not. And so there are going to be clues that will kind of hint towards one side or the other. But the bottom line is that corrective moves offer us pauses to get into new trends. They offer us clear structures, clear support and resistance levels. They also communicate that things might take a little longer. It's very valuable information to us, and it tells us that, hey, there isn't a dominant imbalance in the order flow right now. And so that's very valuable information. The general pattern that you'll see in markets is that more often than not, impulsive move will be followed by a corrective move. And that usually continues until we see a counter trend impulsive move. If you look at kind of all impulsive moves, the majority of them are followed by corrective moves. And usually when you start to see an impulsive move followed by an impulsive counter trend impulsive move, that means that there's a change in the order flow temporarily. And it could be indicating a larger trend change at that time. But as long as the impulsive corrective structure maintains itself, that should tell you there's a very clear trend in place and that there's no indication from the other side of the market that that's going to change. So I want to be trading with that until I start to see changes in the price action and the structures. Now, if you are questioning or not sure how valuable this is, well, it's very simple to run kind of a litmus test to whether this is valuable or not. Look at all your losses where you had gotten in the market and it just went immediately against you. More often than not, you were trading against an impulsive move. And look at all your trades where the wins were very clearly like you opened and it just went almost immediately in profit, never went into negative, and within a certain period of time just hit your target. Most likely you were trading with impulsive moves at that time. So just by looking at your wins and losses, you're going to be able to see very, very clearly how valuable it is to be able to identify and spot these, because you're going to start seeing opportunities as being higher or lower probability just based upon the impulsive and corrective price action that you're seeing in the market. It's a very, very valuable tool and skill to learn because it starts you on the path of, it takes you away from this path of looking for candlestick patterns to kind of be your saver, like pin bars and inside bars and all that. You trade those patterns and you don't learn how to read price action and order flow. You'll also realize that a lot of them are not going to, one or two bars is not going to be more dominant than the last 30 or 50 bars. 99 times out of 100, the dominant order flow is already in place by the time that pin bar or inside bar forms. By looking for candlestick patterns, you're really missing a lot of opportunities because you're limiting the amount of, times that those things are going to show up, and you're limiting your skills. Whereas learning to read and identify impulsive and corrective moves and really practicing as a skill will expand your ability to understand price action, to understand order flow, and to understand how to make good trading decisions. And again, just go back to the litmus test. Look at your wins and losses, your best wins and your worst losses, and see if they went with or against this pattern. I'm willing to bet more often than not, your best losses went against this pattern and your best wins went with this pattern. So that is my first core model in understanding price action context. Now that we've done that, let's take a look at a couple live trades I'm in right now, so that I'm going to explain why I got in these trades, what was my reason for choosing the entry, the stop loss, the take profit, and so you can kind of understand how I make these trading decisions in real time. So I'm in the Aussie yen. I'm in about 79.32, 33. My stop loss is at 79.72, so about 40 pips, and my target is 77.96, so about 138, 140 pips roughly. And I'm going to zoom out to a slightly higher chart. This was a pair that we've been talking about for a while, particularly because they had a very unique and predictable structure to start the year. And so you can kind of see it. So this is pretty much the start of the year. Let's make this a little bit lower here. There we go. So between the beginning of the year, the first week of the year, till a couple weeks ago, the Aussie yen was stuck in a range between 79.65 plus and 77.54. And this is very predictable. We talked about it ahead of time. Hey, look, here's a range, buy, sell, just buy at the bottom, sell at the top. And our students made a lot of money. We made a lot of money. It's been very profitable for us. But then this last time, let's zoom to a 4-hour chart. You'll notice that, so in these prior times that I approached it, it sold off pretty aggressively. You can see the impulsive selling, and then same thing here, bam. And then after a little bit, heavy selling, you can see impulsive, corrective, impulsive, a lot of selling off it. But then here, it has this kind of mini impulsive, corrective, impulsive, but then the bulls could just come right back in. and they say, no, we're going to attack you again. And there's some more selling, and they're like, no, we're coming right back up. And then pretty soon there's just no reaction. The bears are like, okay, we can't mount a comeback against this. And so we get this breakout on the Aussie yen, and it breaks above this range high, and it takes off. But then, after a little bit of a pullback, it tries one more thrust higher, and it just isn't able to maintain this. And it just starts selling sideways, selling, and then bleeds, and then bam, it breaks through. And so if this structure was so dominant before, then after this kind of false break setup here, I'm expecting the structure to continue, which means that I'm expecting that if the bears really were able to take any breakout and make it a false breakout and get the market back in here, they're going to take back control of this, and they're going to target the bottom of this range again. So I woke up, I'll get to an hour chart. I woke up and I saw it break through, and I was like, oh gosh, I got to get in this. And my preferred entry would have been as tight to this level as possible, because if this level had acted as range resistance before, it should act as it again. And so I basically had two orders. I had a short here. I just said, I'm going to guess. I think it's going to go down, but I'll place a pending order back here. And if it comes back and hits it, great, no problem. If not, no big deal. I'm short. That's when it ended up not going back, so we canceled the order, and it has since just taken off. And you can kind of see consistent selling, corrective, and then bam. And then we had another corrective structure here, and it could have bounced, but I'm pretty disciplined, and I felt confident that it was going to continue bleeding lower, and it did. It's gone another 50, 60 pips lower since yesterday when I left the office, and it was forming a corrective structure. So it's continued on with the pattern, and nothing's quite disrupted it yet. So this is a very profitable trade thus far. I mean, I'm up, 104 pips with a 40-point stop, so I'm up 2.5 R at this point. And my take profit is pretty straightforward. The range structure is going to dominate, so I want to target the bottom of the range structure. That's the plan. It's a very straightforward plan. Target the bottom of the range structure. And so I might take profit a little bit early. I might close it out if I think it's, not going to make it. There has been some times where it kind of bounced here or a little bit earlier than that. It seems to have consistently made it there most of the time. But if I feel like it might be making another round trip back up, then I'll get a little bit early and get out for, 2R or whatever. And so that's kind of what, that's the trading decision how I made this. It's pretty straightforward. There's nothing too complicated about this one here. Another one that I'm in right now, which we talked about with our course members ahead of time, was the Swiss index. So you got to zoom out a little bit more, because we just kind of, like many of the indexes, approaching kind of this all-time highs. And so, we hit a resistance here, and then it sold off, and then hits the resistance again. And then the sell-off doesn't quite go as far. Before we made a base down here, and then the base became higher. So bulls were willing to step in at a worse price than these people here and say, no, we think it's going higher. And they were able to push it back up. And so because of this consistent pressure, particularly at the start of the year, it just broke right through it. And we felt like, hey, if it breaks above it, we want to be buyers on we want to buy that. And so let's zoom back in. And again, you can even see kind of the impulsive, price action, dominant order flow in play here. So we get to this resistance again. Let's mark it. And we get this resistance, very weak selling, and then boom, it just breaks through. So as soon as it broke out, I said to myself, yeah, I want to be long now. There's pretty much going to be no more sellers at this point. They've been stopped out. They're not going to want to get short above prior resistance. And so they're going to probably want to push it higher. And so they did. They pushed it here, and I felt like, okay, it's starting a corrective pullback. I'm going to want to get in somewhere between this prior resistance now turns support and a few points above, because I'm not sure it's going to get there exactly. So I got in at 45, the low of that hourly candle. And that was the last hourly candle that pulled back. The low was 38, so I was 37. So 8 points I was 8 points from the low, and after that it took off and it hasn't come back. And so, I feel like it was a pretty good trade location there. And it's since Impulsive, Corrective, Impulsive now formed a large corrective structure. And so now that it's kind of breaking out, I think it's going to kind of bleed higher a little bit. I mean, we are kind of in off hours, so not surprising that things have gotten a little quiet, but my general impression is that this is going to go higher. And so in terms of where I put my stop loss, I put it at 94.90. If I wanted to do it a little more conservatively, I could have put it under this low here, because I'm expecting that there's going to be some buyers around this support level now. But here's where the impulsive move that led to the breakout started. There's a lot of buyers here that push this through. This is 1, 2, 3, 4, 5, 6 hours of straight buying. And so if the market was to kind of pull back here, you better believe these buyers are going to defend this area to some degree. So this would have been a more conservative stop loss location for me. But I felt like they're going to defend this area most likely. What is that? 55-point stop right now. In terms of my target, pretty straightforward. Let me delete this. So once you kind of hit all-time highs, you tend to, there's really a couple options you have. You can kind of, in terms of determining when, you want to take profit. One, which is your ability to read momentum in the price action in real time. And if you're really good at that, then you can kind of read that and wait until it starts winning, and then you start taking profit. That's one way to do it. Another way to do it is that round numbers are very powerful in the sense that when you start hitting all-time highs, you're kind of in uncharted territory, and so there's more likely going to be orders that are going to cluster around round numbers. 9650, 9700, 9750, and I feel like it's probably going to go for a couple hundred points here now that it's broken out of 95, 2730. 200-point move wouldn't be out of the norm for me in terms of, if this really is a strong bull run and, a lot of the indices are very close to making all-time highs. I'm targeting 97.45. I mean, I'm already up, what is that, 80 points at this point. So I'm already up about 1.5 R, close to 2 R at this point, closing in another 20 points on 2 R. So I'm already pretty far in profit. And so it could easily, make with a total of, 200 points profit target and 50-point stop, potential 4R on this trade here. But pretty straightforward trade, nothing too complicated in terms of, it's just a very good trade setup trading with trend. With all that being said, I hope to hear from you. If you want to learn more about me, how we trade, what we're looking at, check us out at secondskiesforex.com. Until then, I bid you all adieu. Good luck trading, and I hope to be working with you soon. Take care, everyone.